It's Wednesday, May 8th. Welcome to MarketFoolery. I'm Chris Hill. Joining me in studio from MFAM Funds, the one and only Bill Barker. Thanks for being here.
Thanks for having me.
We've got restaurant earnings. We've got Match Group hitting an all-time high. We're going to start with Lyft issuing its first report as a public company, and it's a memorable one because Lyft lost $1 billion in the quarter. The company says that this will be its peak year for losses and that it sees a clear path to profitability. Boy, I really hope so, because they just lost $1 billion in 90 days.
Yeah, I think that is not easy to do.
Yes.
Despite the headlines today about one of the leaders of this country having lost $1 billion, that took him 10 years.
Right, not in 90 days.
Not in 90 days. He couldn't do that. Although he did it 3 times, but that's another story.
That's another story.
And yeah, they've projected an EBITDA loss for 1.15 to 1.175 billion. That's a rather specific range, fairly tiny range given the size of the loss. It's like a 1% delta between the high and low of that range on $3.2 to $3.3 billion in revenue. So you've got competing stories here. One, extraordinary growth at the top line. I think 95% year-over-year revenue growth for the quarter, and staggering losses. And the market today has resolved that by selling off the stock.
Right. So worth remembering that, and it's not hard to remember because it was just, a couple of weeks ago that Lyft went public at $72 a share. With the sell-off today, it's at $55. There is a price at which this stock becomes attractive, I suppose. Is the mid-50s where it is? Because and all kidding aside, that's what I was struck by. It was not that they lost $1 billion. It's that they did it in 90 days. And I don't even know how you begin to do that. So it still feels like this is much higher than I would want it to be before I put Lyft on my watch list.
Okay. Well, in saying that they lost $1 billion over 90 days, that is true, but misleading in the sense that a lot of it was related to stock option expense and the costs associated with going public. And so what they lost on an operational basis was about a quarter of that $1 billion, 1.2 billion they're going to lose for the year. So still losing 250 million on your operations when you're not, the 776 million was the revenue, and they're losing 1/3 of that in operations. And so I think that they're obviously not an attractive stock to a value investor who would want to see profits. And in terms of the growth investing public, it doesn't have any momentum stock investors interested in it because it goes down every day. And so that's not the kind of momentum, unless you're a short seller, that you're looking for. So you need to have that all this top line growth is going to translate to profits at some point. When is that going to be? And they're talking about a clear path to profitability. But Uber is going to be a well-capitalized company as of Friday, and can fight them, I guess, as to who can lose more money quickly in pursuit of customers.
Uber has set the range for their IPO at $44 to $50. I've said before, I think that's both smart of them and probably a response to what happened with Lyft stock right after they went public. So among other things, Uber is looking to get in, if not the good graces of Wall Street, certainly the better graces of Wall Street relative to Lyft.
Yeah, and they are going to be judged through the relative to Lyft prism, and as they should be, because there's a direct competitor, and Uber is in a few more areas of business. Uber Eats is a more attractive part of the business than some other parts of the business. But yeah, they have to, at this point, somewhat defend themselves from the market reaction that has befallen Lyft, and say why they should be valued at the top of the range rather than the bottom or below, because people want to see there are enough fast-growing companies which have more clear paths to profitability than the one that Lyft is demonstrating so far. Beyond
Meat, perhaps, could be one of them.
Perhaps. You've spent some time looking at that one. What do you think about their profits?
Well, they don't exist at the moment, but
their path.
Oh, the path. I think the path is looking pretty good for plant-based meat substitutes.
All right, and the path is looking good for transportation as a service. The question is, is the profitability of that attractive? And you're going to have a couple more shifts in the business model. The business model right now, rapid growth but no profits. You've got a lot of people you have to pay, and you've got to compete on price against somebody else who is willing to compete with you on price, and you've got to displace all the cabs. And so the shift is going to come, of course, when autonomous vehicles become a reality, and then maybe you can take your costs down quite a bit. But those autonomous vehicles are going to have to be owned by somebody. Are they going to be owned by Lyft? Are they going to be owned by third parties? Are they going to be owned by the car manufacturers? It'd be interesting to see how that plays out. But it's very hard to model, in my estimation, what this is going to look like in 5 years.
And one more factor at the moment that is not working in either Lyft's favor or Uber's favor is the current unemployment situation in America. The lowest unemployment in close to 50 years. That just makes it a little bit harder for them.
It does. It means a lot of people are getting to work. They need Lyft to help them get to work, some of them.
Yes, but in terms of the employees, the actual drivers, because as you said, they don't have the autonomous vehicles just yet. So when you have the autonomous vehicles, you care a lot less about what the employment picture is in America. At the moment, you've got a lot of people who maybe would be considering signing up as an Uber or Lyft driver part-time, maybe on the weekend, some sort of side hustle, and they're like, no, I'm good.
Yeah. Well, I think, and some of them work for Uber and Lyft. So, yeah, it's a lot of the employee situation is, and they're not all employees, they're contractors. It's a complication, and I think that they have to spell out when the profits come and in what form in order for people to be more interested in the stock, which is not responding well to today's story, which is an impressive top-line story, almost doubling revenues in a year, but that's not the whole story. Where are the profits? What are the margins going to look like when this thing is at scale?
Let's move on to a couple of restaurants. Wendy's and Papa John's both reporting first quarter results. Same-store sales in the U.S. for Wendy's barely in the positive range, just 1.3%. I will say, though, that's not completely out of line with what we've seen from sort of the bigger burger chains. That's basically in between what we've seen recently from McDonald's and Burger King. Papa John's same-store sales in North America down nearly 7%. I guess the bright spot for Papa John's, because the stock is up a little bit today, is that overall sales came in better than expected.
Yeah, Papa John's is continuing to suffer from the damage to the brand from the actions of John Schnatter, both his public proclamations, or not public, they became public over a year ago now, and then suing the company and his being ousted and sorting out, what does Papa John's look like once Papa John himself is completely out of the company, which seems to be coming, as the reports today also include indications that Schnatter has no operational role with the company, is thinking of selling his very large stake, which I think is around 31% of the company. But they're forced now to pay back their franchisees. They're lowering their franchisees' fees because of the damage to the brand, and the franchisees having, made their investments in running these units and then, the company is not wise to spend a lot of money on advertising right now while it's sorting out what kind of a message it's trying to put out to people. They're putting out Shaquille O'Neal as the big reason to be happy about the company right now.
They are, although they're also doing some pretty smart promotions with featuring local franchisees and basically dropping the Johns and just being like, oh, here's your local Papa, and here's the person who runs, a bunch of franchises in your area. So I think that's smart. I think in the case of Papa John's, this was slightly more good than bad, slightly more optimism in this report. And to some degree, that is, as you pointed out, absolutely helped by the reports that Schnatter might finally be looking to unload his stake in the company, because run well, this is a good business to be in. People like pizza, and if you can do a decent job of actually making the pizza and getting to them, then that's a profitable business.
Yeah, and I guess they prefer pizza that comes without controversy.
Yes,
which is there are so many choices of pizza that are non-controversial pizzas. Many people find pineapple on pizza to be controversial, but they don't have to get pineapple on their pizza.
Right.
And when you're going to Papa John's, you're just buying into controversy at the moment.
Right. And most places in America, whether it's a big city or just small town, you've got options when it comes to pizza. There are a lot of local places that do it.
Yeah. Or you can go over to Wendy's and get a burger.
You can, although apparently fewer people are doing that.
Well, they're still showing up. I think what were the same store sales? Around 1%.
Yeah, just over 1.3%.
So they're doing okay. There's nothing exciting about the report. They are opening and shutting restaurants in about the same pace. I think they had 43 total global new restaurants, but that only net, I think they closed one more than that. So system-wide sales are sort of treading water, 1% same-store sales. It's okay, nothing special. It's a stable burgers. They're working on upgrading their menu, so that's a thing. I think they were pointing to the Asiago cheese and applewood smoked bacon elements that you can get with your burger.
But I don't get the sense that Wendy's on a system-wide level is doing the same type of investing that you and I talked about recently with McDonald's, where the investments that McDonald's has made in kiosks. And again, it's all geared towards the same thing, which is how do we increase throughput? How do we get more people through the line in an hour than we have been getting? And how do we raise the average ticket price? And in the case of Wendy's, it seems like they're focusing on one but not the other. It really seems like they're focused on, okay, if we can sell some more premium items, and they've said that, then that's their pathway to increasing the average ticket price. I don't get the sense that they're making investments to really boost the throughput in the way that McDonald's is.
No, the investment seems to be in their Twitter account.
Do they have a strong Twitter game?
They do have a strong Twitter game.
Oh, okay.
Are you unaware of that?
Apparently I am.
No, they're pretty good.
Okay. Well, let me know when that translates to higher throughput, because that's great from an entertainment standpoint, but that's not showing up on the balance sheet, as we like to say. The stock of the day is Match Group. Match Group is the parent company, of course, of Match.com, OkCupid, Chemistry.com, which is a dating site, not a science site. I actually, check that out. And Tinder. First quarter report was fantastic. Profits were up, revenue was up, subscribers are up, and shares of Match Group are up 12% and hitting an all-time high.
Yeah. This is a force, and it's largely due to the Tinder. They've got a lot of different brands, but Tinder is most of the story about what is going on, in terms of the massive profitability that is growing there.
Well, and you and I were talking earlier today, neither of us have used these apps. we met our wives
back in the old days.
Back in the old days, before there were apps. But as you pointed out, Match Group. That's if Match Group works out for you, then you're leaving.
Yeah,
there are probably half a dozen or so people here at the Motley Fool who have met their spouse through Match.com. Tinder, however, is not so much about I'm looking for someone to spend the rest of my life with. Tinder is much more I'm looking for someone to possibly spend the night with.
Right. And so that is just purely from an economics perspective. Repeat customers are better than one-offs. And so all the other elements that they have, and they have a lot of different ways that they are hooking people up, whether it is for lifetime matches or that they've got segmented by age, and they're different brands around the world, and by some that are targeted at racial groups. And so all of this is, for the most part, or a lot of them, are about finding your lifetime partner or longtime relationship, and they're categorized as higher relationship intent, is how they refer to Match or to Our Time and things like that. But Tinder is not about long relationships, and therefore it is more of a model where you can satisfy people by finding new opportunities constantly and expanding the ways in which the company does that. And all of which is to say that I think it's a good thing that we're talking about this today, rather than during apropos of nothing, where we might, or you probably might, work a little more blue on this topic.
We don't work blue on apropos of nothing.
Well, we lace apropos of nothing with some alcohol.
Yes.
Which tends to increase the chances of ending up in territory that's a little bit blue.
This is a clean show.
Absolutely. This is, as well apropos of nothing. It's just you're working with kindling there.
There is a little bit more kindling in the form of some high-level alcohol. Let me go back to the actual investing, though, for a second here, because I think something that often gets overlooked with Match Group is Interactive Group, IAC. Shares, because IAC, headed up by Barry Diller, who has a great track record when it comes to media, entertainment, and I would throw social media in there as well, type of properties. IAC owns a big chunk of Match Group. And so it's not just shares of Match Group that are hitting an all-time high today. IAC is also up, not as much, up about 5%, but that's also hitting an all-time high.
Yeah, they do own that. A few other things that are also, they own Angie's List and all that stuff. So a few
IAC has a very big portfolio.
Although this is a very large chunk of it at this point, and Match Group, that is. And so the nice thing about Tinder is that people are likely to be customers for a fairly long time, and you can get people to pay more and more and more as it becomes more successful at finding the kinds of Tinder matches that people are looking for. And that gets the economics of that are just looking extremely good in terms of the revenue growth for the companies compounding at over 150% over the last 4 years.
Unlike Lyft, they're actually profitable.
They are profitable. And that is one of the differences between this and many other sort of software cloud-based services, where the scale involves you're not having to employ massively greater numbers of people to get massively greater numbers of service done. And you've got network effects as well that are very attractive. The more people who are using Tinder, the more you want to be using it, because there are more choices for you. And then they've got all of their, super likes and boosts and, things like that, which are increasing the addictive nature of the property.
one more thing I'll just add in terms of the business is, unlike Lyft, which has a direct competitor in Uber and vice versa, I'm not really sure who the Pepsi is to Match Group's Coke. I mean, I suppose it's eHarmony. I don't know how many properties eHarmony has beyond its signature one, but it really feels like it's in this industry, it feels like this is Match Group's world and all other competitors are living in it.
Well, yes. I mean, they have most of the best known names. I think that Bumble is a reasonable competitor and is attractive to more of the female-focused generating the contact model, and so that has been gotten off to a good start, but it's way, way, way behind Tinder.
Last thing before we wrap up, as you touched on, coming this weekend, in your MarketFoolery feed, it will be a bonus episode, an apropos of nothing, which we're going to be taping tomorrow. We'll be taping on Thursday afternoon. And for those who
not too late to get topics in.
That's true. A couple of people.
We need some.
A couple of people have emailed marketfoolery@fool.com suggested topics. And for those relatively new listeners who are thinking to themselves, what are they talking about? Apropos of nothing is something we've done a few times where we get in the studio and we don't really talk about anything to do with investing or business or that sort of thing. It's just talking. It's the two of us and a third person. Bill Mann has been here for this, Matt Greer, Robert Brokamp. So we're going to dragoon one of our colleagues into this tomorrow afternoon, and it'll come this weekend. And as I always like to say, you don't have to listen. That's why we put it out as a bonus episode, because we want to keep the promise of, no, we'll be here Monday through Thursday with business news and investing takes. But every once in a while on the weekend, we're going to drop an apropos of nothing, and it'll be long and it'll have nothing to do with investing.
We're going to have a bottle of something open during this, right?
At least.
Are you providing?
Yes, I will provide something.
Actually, MFAM is sponsoring the alcohol.
Really?
Show, yeah.
Well, I hope you're not expecting any sort of promotional consideration, because you won't be getting it.
MFAM? MFAM funds will in no way be getting any mention during the podcast?
Not on apropos of nothing, but I will just...
Perhaps this one.
On this one, I'll just say, if you want to read more from Bill Barker and his colleagues at MFAM Funds, you can go to mfamfunds.com and sign up for declarations. It's the free monthly newsletter. First of all, it's free. It's free, people. It comes once a month, which is the thing that I like about it, because it's not clogging up my email box. It just comes once a month. And it's really smart stuff about investing. So check that out when you get a chance.
And this will be the first time that MFAM, in its sponsorship of Apropos of Nothing, will be at $1 billion or more, actually. In funds under management.
In AUM.
Yeah.
Nice. Yeah. Nice. You know who might want to talk to you about that AUM? Lyft. Because, Bill Barker, thanks for being here.
Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.